Good morning. Dollar against the Swiss franc is setting up potentially for a significant breakdown. Looking at the weekly chart, we've broken a decade-long support. It has been since May, obviously, but it doesn't look like we're going to see a a retest anytime soon. So both short and long term is to the downside. So let me show you why fundamentals and technicals are probably aligned for some Swiss franc strength. There's, of course, two major forces here that we're dealing with. Always we have a currency pair. The Fed's fought the Dovish Pivot. Powell gave a dovish signal on Tuesday. He acknowledged downside risks to the jobs markets and hidden that there is going to be an rate cut in October, and the Fed that also is nearing the end of quantitative tightening. So we have nearly 100%, 97% also of a cut in October, and two more cuts by December pretty much are kind of fully priced in, nearly priced in. This is happening despite the government shutdown, of course, that shouts the cloud in the jobs data. When the Fed cuts blinds, of course, it cuts aggressively. On the other side, Swiss franc has strengthened nearly 9% over the past 12 months, and we're now testing, where are we? Like 78, 78, like close to 78, actually. Here's the key. Trump's tariffs, which we have seen an escalation since last Friday, are hitting Switzerland hard, forcing the government to slash GDP forecasts. But the SMB cannot really intervene in forex markets while trade talks are still ongoing. So that means, in my mind, that franc is likely to stay strong by default. Also, with inflation data stable, the S&P isn't cutting rates aggressively, so they're comfortable around where they are. Now, apart from this consolidation pattern that we saw prices going over for like nearly a year and a half, typically what happens after we see range breakouts, we extend to the 100% of that range. So if we do use that approach, we see that prices could go all the way down to 74.17. Okay, 74.718, let's say, right? Of course, equally, Fibonacci tool is much easier to use, for me at least. So we do the 100% from that. It gets you to some numbers as well, just to be sure. So we see the 200 supposedly it's down at 74 around level. So I will just take that off just to make sure we don't have a cluttered image. What else I want to show you though, apart from that, right, is something that is actually aligning on the technicals, both for short and long term. And I will tell you actually they're short term. Now, this is potentially an opportunity down to the 70 and below, because this is the low we have had since 2011. You might ask why. Well, there is a high likelihood, okay, that this pattern, the 10-year long pattern or so that was just broken out last year or so, is this is like a running triangle, guys. Running triangle, because the first wave, yeah, the first wave in this particular case is a bearish triangle. The first wave is below the second peak. Okay, so that is why it's called a running triangle. A normal triangle would be that wave C would be below wave A. Okay, but this is a running triangle. So what this implies eventually, well, there's a few things that we can do to find out lower prices, but one would be to use the range from wave A to wave B and then the wave E, find where we could potentially go. And the measured move of this particular method takes us down to 68.40. The measured move typically, which takes us from the breakout point. Okay, so we would have to go at the top in this particular case, which is the wave C, right? Shows us 69. But both waves and both ways, right, actually show levels below 70. Why is this important? It's important because it's below the previous low. And why is this important? It's important because if indeed this is a triangle pattern, it means that we have to see another low. Why? Because when markets move in triangles, right, we have to see another leg to the downside before the previous low, below the previous low. That means that if indeed this plays out as a triangle, not only the short to medium term is bearish, but also the longer term, and prices are going to head towards the 70 handle. So we currently are around the 78. So if we took a short position at the bottom of that, which is an aggressive entry, with a risk at above this resistance, which is a very strong level, and it's not looking like much like we want to get there anytime soon. Let's just put it at 70 or 83.75, and this is a long-term trade, and we place that down at 70. Okay, this is a sort of long-term breakout trade with still good risk to good ratio, despite that particular entry, which is not, it's an aggressive entry and close at the bottom of a trend. Essentially, though, because I'm looking at this also in the shorter term, shorter, what could eventually happen here? We could see a triangle pattern, a wedge pattern. Wedge patterns in this particular case, if we do see another leg down with divergence as well, could be an indication of either a terminal wedge, which means we're going to see a reversal, or potentially it could be a leading wedge, which means we're just starting that leg and further downside. Okay, which would be, of course, the scenario that would create more downside pressure. Okay, so just to make it a little bit more clear for you, markets move in 5 waves when we move in the direction of strength. So that would be the 1 and the 2, and we'll see 3, 4, and 5. Okay, in the ideal scenario. In the non-ideal scenario, this is 1, 2, 3, 4, and 5, and which means that we probably ended that leg to the downside. We're going to start moving higher up, and of course, the entire situation is going to change in the long term. Perhaps not even in the long term. Maybe we're just going to see prices moving up all the way here and then go lower down. Okay, do not know how this is going to play out, but one way or another, for those who prefer entries not at the bottom because it's likely that we'll see a move to the upside, I would be looking to place my Fibonacci tool down here and look for at least one more leg down that would give us the wedge. Okay, then potential move to 23.6. I don't think I would want to leave it to go higher than the 23.6. And if that happens, so those who want to prefer the pullback might miss the opportunity, and then a potential leg to the downside. So this is how I'm looking at this to play out. The key levels for me are, of course, this resistance at 83.75, very important long-term structure, and the current support at the around the 78.16. Okay, which if we break strongly, it would probably mean that we will be looking for further downsides. But it's the setup is more like a sell the rally, if that makes sense, with targets closer to the 70 level in the longer term and a stop above this important important well, now resistance. So yeah, bottom line, USDCHF broke a decade long consolidation, okay, over here, and we are looking both macro and technical forces that point lower. Of course, the risk is that Fed becomes more hawkish or the S&P more dovish, which would mean potential reversal, and we'll have to pay attention to fundamentals. We are targeting, I would say, the I would say the 70, close 77.50 or so in the short term, and any runs to the upside could be opportunities for entering short positions. So yeah, target the lows and catch you next time.